This would be a really good conversation. Ernest is wildly knowledgeable when it comes to quantitative models, trading, markets, and how we should think about artificial intelligence on a go-forward basis when it comes to this domain. My name is Michael Agayed, publisher of the Lead Lag Report. Joining me for the hour is Mr. Ernest Chan. Ernest, introduce yourself to the audience. Who are you? How'd you get involved, interested in markets, and what made you gravitate toward the quantitative trading side of things?
Well, first, thanks for inviting me, Michael. Very excited to be here. I didn't start my career as a trader or fund manager. I somehow got into it through a bunch of coincidences. So I started my career as a machine learning researcher at IBM in natural language processing. Very similar to what OpenAI is doing today. But of course, when I was at IBM, we were using an earlier generation of technology. But one strange thing happened when I was at IBM is that many of my senior researchers, managers started leaving the group. And that is not because of my bad personality. Mostly, they went to a then unknown hedge fund called Renaissance Technologies. And many of us couldn't understand why someone would leave the mighty IBM and go work for a unknown fund. But we were intrigued, and several of us have also decided to explore the financial world. So at that time, the Morgan Stanley AI Lab was just starting up, and I became one of the top first 10 employees. So I joined Morgan Stanley after 3 very productive years at IBM Research. And that was the beginning of really my career in the intersection between AI and finance. After working for many different investment banks, hedge funds, what have you, I decided that I wanted to start my own shop. So some 11 years ago, I formed a commodity pool operator called QTS Capital Management, and it still exists today, and frankly, doing pretty well. But we hired a CEO to take over day-to-day management, while I go back to machine learning, particularly financial machine learning. And I founded a new firm called PredictNow.ai that focuses on really popularizing the use of machine learning in asset management. So that's where we are today. I'm more than excited, and it's amazing to see really that AI has really grown leaps and bounds since I first started in this field. It is, it practically, every week, actually, every day, I learn something new, and every day I can think of new ways that AI impact asset management. The list keep growing as we speak.
All right, let's first define some of these terms for the audience, just to have a level playing field. So, explain what machine learning is. I mean, to me, it's very simple, right? It's essentially regression analysis.
Yes, well, you might certainly regard linear regression as a kind of machine learning. Essentially, machine learning. So traditionally, when people say AI, they might mean something called expert system. In many decades ago, there are already people who program a computer to play chess, right? I mean, as a kid, I was always, competing against my computer. But that was not machine learning. That was AI, you might call it, but it's not machine learning because a human was programming that computer. They insert all the rules of the chess moves. If somebody move forward a pawn, what should you do? And what should your bishop move when the queen is within, 2 squares of you? Those are expert system that human program. They are not machine learning because the machine does not learn from past moves by itself. That is actually very similar to what quantitative trading is today, right? Most of you, have heard of algorithmic trading or quantitative trading, and I wrote 3 books on it. And quantitative trading today is essentially, the human traders say, well, it looks like buy low, sell high really work. So why don't we program the computer to buy me a E-mini future every time the daily return was below 1%, and then sell it when it recovered to, let's say, 0%. That is not machine learning again. That you might still call it expert system because a human is behind it all. Even though the action is mediated through software, but the human is defining the rules. Real machine learning is not like that. Real machine learning is where the computer learns autonomously from past data. It might look at the historical returns data and decided that, well, one of the trading rules should be buy low, sell high. Another trading rule might be, well, buy high and sell even higher. And the two trading rules should have this and that entry and exit parameters. This would be, if the program discover buy low, sell high, and or a momentum strategy on its own, that would be machine learning.
Okay, now what's interesting to me about this discussion is for machine learning to work, you alluded to it, you need to have data, and it's relying on probably more recent past data to try to make a decision on what to do from a go forward basis. When you apply that to some domains, that works really well because the rules are fairly defined, and certain domains that probably don't have chaotic system elements to it, that would work, I can imagine very well in. But when you're dealing with markets, when you're dealing with investing and trading, there's a chaos theory element to it, right? There are butterfly effects that can create massive dislocations across asset classes, various stocks. How do you think about that AI component in the context of something which is not clearly definable in terms of cause and effect, where small things can have big differences?
Yes, that is a very good point. And in fact, that is the main reason why machine learning in trading in its naive form has not worked very well. In fact, one of the most notable expert in this field, Dr. Marcos Lopez de Prado, has a lot of presentation. I've listened to several of his presentations at conferences with the title "The 7 Reasons Why Most Machine Learning Hedge Funds Fail." So you know that it can have worked very well. And the naive application of machine learning is exactly like what you described and what I described earlier. Just let the computer loose and learn trading rules on its own. But as you pointed out, the market has very low signal to noise ratio. Very low. It is not like asking the machine to learn Shakespeare, to write a poem in the style of Shakespeare, or to learn to write a program to do certain things. That we know that ChatGPT can already done. It's already a accomplished task. But even if you ask ChatGPT, discover a pattern in the Eurodollar futures market that is so that we can reliably generate profit, I would be very, very doubtful that ChatGPT can return such a rule. Even if it does so, it's probably hallucinating. Don't believe it. And no matter whether you're using ChatGPT or you are using classical supervised learning, random forest or neural network or whatever you're using, to directly learn from past data to create a trading rule is very difficult and has so far been very unsuccessful for most people, although obviously there are exceptions in every field. And the reason is precisely like you described: low signal to noise ratio, and also the moment that you see a pattern emerge in the past, typically the machine is not the only one that see it. Many other traders, humans or other statistical arbitrage formula, have captured that. And by the time that the machine learning system have learned that pattern would have disappeared, because the market, unlike Shakespeare or unlike the vast corpus of programming snippets in the web, it has arbitrage. It has what George Soros would call reflexivity. The fact that you discover a pattern will make that pattern go away, because you are not likely to be the only one who discovered it. There's alpha decay, there's reflexivity, whatever name you call it. The pattern is self-limiting. You can never discover a high, significant signal without it being discovered by other people and that have the edge eroding. And that is fundamentally why machine learning in its naive usage, and I emphasize naive usage, has never worked very well.
I would take it a step further. I mean, which goes to the reflexivity point. It becomes a victim of its own success. So even if there aren't others or other AIs competing against it, and whatever the anomaly is that the AI is taking advantage of, isn't seen by any other AI, there's going to be presumably a human element to then leverage up on the anomaly that the AI is trying to take advantage of, right? So And the moment you do that, that's where you end up having failures, because the moment you add leverage to something which is highly complex, that tends to result in fat left tails.
Yes. Now, and I think there is one advantage of human over the machine in trading is that oftentimes when when they look for a trading strategy, they are looking not just at correlation. I think that here we should differentiate between correlation and causation and causality. For a machine learning system, so far, I would say 99% of machine learning systems, they are looking for correlations rather than causality. So if they say, if the a full moon tend to lead to a market going up the next day, if they see a correlation of, let's say, 51% of the time that happen, they will encode that as a trading rule, no matter whether it makes sense or not. Okay, but for a human trader, they say, this looks like correlation. It's not causality. How can a full moon affect the market? Oh, maybe there is a way. If scientists discover that full moon affect people's mood, or it affect the blood circulation, or whatever industrial production, maybe you can argue that there's causality involved. But until such a cause is discovered, a trader would be very skeptical of this rule that whenever there's a full moon, the market will go up next day. And so for the human, we are rational beings that always look for fundamental causes, not just association, unlike the machine learning programs. So we have an advantage in sort of filtering through some of these random noises that appear in the market. So, for example, a lot of times I like to use my favorite trading strategy, which is a intraday trending strategy. And it's no big secret because it's been written about in many academic papers, right? So there's typically a intraday trend in the U.S. Index futures market says that if the index future go up a lot, it typically will go up further towards the end of the day, and vice versa if it goes down a lot. And that kind of intraday momentum has a root cause. And the root cause of that is because of rebalancing activities, because of market makers have to rebalance to bring to gamma to delta neutral, to bring the portfolio to a delta neutral position, because of volatility. Variance swap dealers have to also bring their position to delta neutral, because of a lot of the leverage ETF have to rebalance to keep their leverage to the what they were designed to maintain, and many other reasons. Now, these are the reasons that we human take as causes. They are not random correlation that most of the time the market, if they go up 1%, they will keep going up towards the close. It's not a pure coincidence, not a correlation, but there are actually identified causes, and you can test these causes. You can construct, for example, natural experiments to verify that these are really causes of intraday momentum. And because of that, you have much more confidence that such a trading strategy will work for some time, unless some of these causes disappear, right? So you might ask, what do I care if this is I find a root cause, or if it is found by machine learning program? As long as I trade profitably, it's good, right? That is not the case, because a correlation can go away for no reason, whereas a cause and effect would only go away if the cause disappears. So you would look for the situation where the cause is no longer there, and you would stop trading that strategy. A computer, a machine learning program will not do that, because the machine learning program cannot. So far, maybe 10 years from now, ChatGPT will learn to understand cause. That would be a higher level of intelligence, but not as yet. As at the current time, it is only looking for correlation, for association, and because of that, it wouldn't know when to stop. Essentially, it wouldn't know when the rules won't apply.
Which I think is interesting in context, because only an experienced human with humility in recognizing there are not that many true predictors to markets would know what doesn't work, because most things don't work.
That is true. Most things don't work, but actually, if you run a machine learning program and say, find me 100 rules that has worked in the past, that would be profitable in trading euro dollar futures. I think in no time we will give you 100 rules, right? No problem. And if you backtest those rules, they all are, would be profitable. I don't know that they would necessarily have a Sharpe ratio of 5, but hey, they would be a Sharpe ratio of 0.5. Some would have a Sharpe ratio of 1. And if you run a whole bunch of 100 of these rules, you probably generate a Sharpe ratio of, hey, 1.5. No, I don't think it's difficult. The only problem is because these are relying on correlations, not causality. Most of these won't work going forward.
Right. Now, and there's another element to this too. So just talk about correlation versus causation. Parallel to that would be frequency versus magnitude. So markets don't follow normal distribution, although post QE3, the S&P 500 had what looked like a normal distribution, no real fat left tails. But the markets historically are supposed to have that sort of dynamic of staircase up, elevator down in the path behavior, frequency of positive returns versus magnitude of a large negative one, which defines a lot of historical returns. How does the machine learning AI side factor in those dynamics? Because if you're going to use recent data and you're going to have this learning aspect, learning is based on frequency, whereas small samples, small outliers can ultimately define decades of performance.
Well, I would say that the current generation of machine learning program wouldn't be able to do that, and that's why we at Predict Now we don't use that naive way of we don't deploy the naive way of using machine learning, which is to ask machine to discover rules, right? Because like you said, the fat tails occur so infrequently that if you just let the machine loose on data, it would pretty much ignore those rare events, right? So the way we use machine learning is what we call corrective AI. That is to say, the human create the trading strategy that recognizes that there are extreme events. In fact, one of the first trading strategy that we apply machine learning, that we apply corrective AI to, is a tail event strategy. The strategy only make money when there are tail events. It focuses only on tail events, where which actually are not as rare as a normal distribution would imply, right? So practically every 2 years is my count. When we started the strategy in 2012, we basically make money every 2 years because for example, in 2018 there's the Farmageddon. And then in 2016, there was Brexit. And then in 2015, there is the Chinese stock market crash. And 2020, of course, there's COVID. And 2022, there is the, whatever that everybody know what happened in 2022. So, it's an amazing regularity that the tail event happened almost every 2 years. Hardly can be considered black swan, right? But the trading strategy focus only on those events. So if you run a machine learning program to discover those events, chances are it will ignore it because things that happen once every 2 years already is too rare for machine learning. But what we use the machine learning program for is to apply it on top of this tailhead strategy. We want to find out on a daily basis when it is not a good idea to run this trading strategy. And that particular application of AI, which we call corrective AI, is actually quite successful. That is the first time, to be honest, I have found machine learning to really add value to trading. Is not to find patterns in the past, but to find out whether a strategy will likely work in a certain environment. Because and the main reason that this application of AI work instead of the naive way of using AI is that there is no arbitrage. Why? Because even if I tell you, let's say, you are running a strategy and I broadcast to the world that, hey, MicroStrategy is going to lose money tomorrow. And then the next day I say MicroStrategy is going to make money the next day. I broadcast to the world and no one is any the wiser what MicroStrategy is. So you cannot arbitrage against it. Even if this information is public, shared with everyone, there is no arbitrage because the machine learning program is not predicting something that anyone can trade on. It is a meta program. It is operated at a higher level than at the the public market level. It is operating on top of a trading strategy, which Michael obviously is not going to disclose to the public. And so that application of machine learning, which Dr. Marcus Lopez Prado said, call it meta labeling because of this meta level of where it is operate, but what we call corrective AI, because it's correcting the underlying trading program. That's the only really successful application of machine learning in asset management that I've seen until recently. So now going forward,
which to me, well, hold on, but that to me sounds very much just like, I mean, at a very kind of naive level of understanding, that's essentially identifying the current cycle, which, you know, for most is hard to do until 2 to 3 years after the cycle is already underway.
Well, you know, it's the machine is not necessarily more intelligent than people, right? So a lot of traders would say, okay, a trending strategy is unlikely to do well when the volatility is low. And that is true. That is true. But there are many, many pieces of wisdom like that. You know, I identify one wisdom. And some other wise sage might say, oh, you know, trending strategy is likely to do well when, you know, gold prices surges without a corresponding surge in oil price. Maybe that is the case. So, you know, machine learning in this case is kind of aggregating all this wisdom, because nobody can say that there's only one way to tell whether a trending strategy is going to work, and that is volatility. Nobody can say that. What if, you know, somebody else might think gold price is important. Some other person think that interest rate is important. So machine learning in this case is kind of aggregating the wisdom of everybody. Everybody has some partial truth in their point of view, and it aggregates it and it computes a number which we call the probability of profit for a particular strategy. And so you might say that, well, that's nothing new, that it says that you know, the probability of profit of a trending strategy is low when the volatility is only, when the fix is only at 12. I would say, yeah, sure, but you know, but these other guys think that this should work when, because the gold return is very high. So that is a kind of a, you know, it's not really exceeding human wisdom, but it's sort of aggregating all of human wisdom in this sense.
How do limits on position sizing factor into that? So I can clearly envision a scenario, for example, where some machine learning is basically saying this is a 99% likely profitable trade, and in the absence of some kind of rules that indicate how much to position into that 99% confidence type of trade, it could result in, you know, 100% position, or maybe over leveraging. And it so happens that if the 1% hits, it's like a risk of ruin. I mean, how do you factor in not just sort of the pattern recognition and the learning, but also to the risk of a severe loss in the event that the machine learning is wrong?
Well, so this particular machine learning layer is not going to recommend a new trade, right? So the strategy, if there's a severe loss, is all the fault of the underlying strategy. It has nothing to do with the machine. So the machine learning layer only provide this number, which is the probability of profit. How you use that is something that the trader can decide. So typically there is what we call a bet sizing curve, right? So if the probability of profit is zero, you know, typically you should set the bet size to zero. If the probability is in the unlikely scenario that the probability of profit is, you know, 99%, then, you know, you would set it to the maximum bet size that you can tolerate, and that could be, you know, whatever maximum level you would set anyway. So the machine won't you know, exceed whatever limits that you have pre-approved, essentially. Now, it does not mean that your system will never have a severe loss, because sometimes even, you know, the machine obviously can be wrong when it identifies that the probability of profit is 90%, and it could still be wrong. You know, that trade actually going to lose money, and it could lose a lot of money, you know, not just a little, but a lot of money, because, hey, you know, it's a probability. You know, whatever probability is, that means that it is not certainty, right? Unless it's 100%. So the strategy can definitely still lose money, but whenever it loses money, is the fault of the strategy. And well, of course, whenever it makes money, it's also the virtue of the strategy. But the only thing that the machine learning layer does is that it reduces the number of bad trades, or it reduces the capital when there's a bad trade occur. So it is in a fundamental sense, is a risk management system. A risk management system will not hopefully increase the risk of a strategy, but it will decrease the possibility of a large drawdown or sustained drawdown. And that's something that we have seen that had worked with multiple strategies so far.
Question from one of the audience members who DM'd me. Question is, could you please ask Ernest about how he manages overfitting / bias variance trade-offs? His books are focused extensively on technical analysis. Any plans on incorporating further intermarket analysis beyond just single asset class? So the overfitting point is always the challenge, and I think that's where most hedge funds end up failing. They end up having thousands of variables that explain why markets do what they do. And I always go back to the point that every variable has an error, and the errors then have correlations to each other. How do you think about sort of that chasing of optimization in the context of machine learning?
So because we are, using machine learning as corrective layer rather than the underlying layer, that in itself has reduced a lot of the scope for overfitting. Because like I said, overfitting occur mostly because of patterns that occur in the past and that no longer occur in the future because it has been arbitraged away. If the way that we use machine learning as a corrective AI layer, that won't happen because, like I said, there's no arbitrage occurring. But now there are always the traditional overfitting that any machine learning program will suffer, not just when it's learning from the financial data. You can be applying machine learning to recognize the images on the web, or you can use machine learning to identify certain songs that are written by the Beatles, for example. And all of these suffer from the bias variance trade-off, overfitting trade-off. It is universal to any data and any machine learning algorithm. And so, but because it's universal, there are standard algorithm to deal with it. We have many, many decades of advances in machine learning. There are things, for example, one of the major advances in neural network is called a dropout technique. So many people thought, what is the difference between neural network and deep learning? Why is all this hoopla about deep learning? What happened to neural network? Well, the difference between neural network and deep learning can be drilled down to exactly one particular technique that is invented by Dr. Jeff Hinton, and that is the dropout technique. The dropout technique randomly punch holes in a neural network and remove nodes. That's it. Let that sink in. Just randomly punch hole. And that has brought us the deep learning era. And from deep learning, it come to our transformer era now, which gave us ChatGPT. Imagine that. That's just one simple technique. Any elementary school student can understand it. And that is the key technique to avoid overfitting, if you can believe it. The key technique in avoiding overfitting is to punch holes in your neural network randomly. And now, this is not the only technique, of course. There are other techniques such as cross-validation, there's random forest, and so on and so forth. Feature selection. So in the machine learning community has a extremely deep bench of talent nowadays. There are, by some estimates, hundreds of thousands, maybe even 1 million researchers working in machine learning, and everybody have been focused on tackling the bias versus variance problem. And I can confidently say that it has been solved. This problem has been solved. It's no longer a problem in machine learning. What you're seeing when the machine learning program overfit in finance, that's not because of bias versus variance. That is because of arbitrage. And we have also removed this problem from corrective AI. So at this present time, I would say, do not worry about overfitting. Do not worry about bias versus variance. Do not worry about arbitrage. That problem has been solved. Put it out of your mind.
Just the remaining minutes here. Everybody, please make sure you follow Ernest Chan, and I encourage you to take a look at his books available on Amazon, very well reviewed, and certainly very deep in their way of thinking about how to put together an approach like this. Another question I see here is, can Ernest comment on using machine learning to predict quantities other than price, sales, capex, margins, etc., and using these predictions versus expectations to generate trades? So I think more of a fundamentally driven approach as opposed to price different approach?
Now, that's a wonderful question. And I congratulate you for thinking of this, this use case of machine learning. This is going to be a very fruitful use case. And the reason come back to the same point. There is no arbitrage, right? Supposing that your machine learning program has a 100% accuracy in predicting Microsoft's next quarter earnings. Well, will it change the earnings? Not at all. Microsoft is not going to say, Michael was able to predict our earnings. Let's spend more money so that we will flout his prediction. So let's decrease the earning by hiring a couple more people. They won't do that. Who cares? You can predict my earnings. It's great. If my earnings can be predicted precisely, all the power to you. It's nothing to me. So, all those quantities that this listener try to predict are the quantities that cannot be arbitraged away. And so the likelihood of success is very high, I would say, a priori. Now, whether that can lead to commercial application is a different matter. Just because you can predict Microsoft earnings exactly does not mean that you can arbitrage on using that information. Because many, many other people might be able to predict Microsoft earnings to the second digit. And everybody would be pre-positioned based on that prediction. And so in some sense, the efficient market hypothesis took over. So nothing to be gained, even if you can predict all these numbers precisely. Now, that is, of course, a very extreme scenario. Obviously, not everybody going to be able to predict Microsoft earnings exactly. So there'll be some better prediction and there's some worse prediction. And the people who are predicting with more accuracy likely still have an edge. So you are just going to hope that other people's machine learning program that are also used to predict Microsoft earnings is less accurate than yours. That's your only hope. But it does not necessarily imply, a perfect prediction of these kind of quantities does not necessarily imply that your strategy will be highly profitable. It depends on what other people are doing as well.
I want to go back to what you were saying earlier about how every 2 years it seems like there's a tail event, and you went through them, and then you said with 2022, and you kind of paused, not clear on how to kind of frame it. I'm curious, just would you consider last year a tail event? Because if it was, the way that it played out, I'd argue, was very non-traditional as a tail event. You had almost like you can argue a controlled implosion of stocks and bonds, not sort of a magnitude event.
Yeah, last year I would say that we already had a correction in the beginning of the year because of the euphoria over meme stocks are over. There's a correction on the tech stocks, but of course we then have a war going on which exacerbate inflation. So it really accelerated as asset commodities inflation, which of course filters through to the economy. So I would say that it's a tail event because of certain exogenous event, in addition to this large correction of the excesses of 2021. So it certainly it's hard to characterize 2022. It's definitely a tail event, but the cause of that tail event is multivariate. It's not just because of correction, it's just not because of war, the multiple factors. So it's kind of a mess. And every time the equity try to rally, there's a crash of some sort going on, the crypto crash and whatnot. So there are multiple tail events, and generally have been a great year for trend following traders and many, many other hedge funds. It's sort of the year that you might call it the revenge of the nerds, or the revenge of the hedge funds is what characterized 2022.
Yeah, I mean, certainly the revenge of the managed futures players, right. I mean, it was really them, because they were essentially playing the long dollar and derivations of that. I mean, that was sort of the key for last year.
Agreed.
Now, some people in hearing that would say, okay, well, the best time to buy an asset class is after a tail event happens, because tail event often means, it's a buy low opportunity. But you and I both know it's possible to have 1 in 1,000-year events happen back to back, depending upon the end of the first 1,000-year cycle and then the start of the next 1,000-year cycle. I'm curious, is there anything that you've seen that would suggest that there might still be another tail event that could happen sooner than that kind of 2-year rolling cycle you identified?
Well, certainly possible. I mean, recession is one possibility. certainly, some people can argue that the Fed has over tightened, the conditions and leading to the start of the bank failure, and it might still have ramifications that we have not seen yet. So it's certainly possible that there will be a tail event coming in the next 6 months. But we got to the strategy of always buying after a tail event has occurred. At the coarse grain at the coarse grain scale, it is certainly reasonable, because we know that it's the flip side of that is a phenomenon called momentum crash. That has been well studied in financial academic finance circles. Momentum crash means that a momentum strategy that has worked very well in a crisis, in a tail event, will typically have a drawdown of varying duration, right? For sometimes for years, sometimes for months. And so the flip side is that a mean reverting strategy, namely typically meaning buy low, sell high strategy, would work very well in the aftermath of a tail event. The trouble is that sometimes this tail event is not a single event. It could be an extended tail event. How do you know that this particular tail event is over, so that you can start running your buy low, sell high or mean reverting strategy? That is more of an kind of a art than a science. You can only identify the end of a tail event only in retrospect. You can never identify it while you are, a very short time distance away from. You never know whether in other words, the true all-time low is. If you could identify that, of course, everybody will be billionaire. So that's the problem, is that at the coarse grain level, yeah, sure. If you buy after the tail event, typically it is profitable. But how would you know when the tail event actually ends? Is always the problem.
No, and actually that's an incredibly important point, because we could still be in the tail event. Yeah, if you view it it's not just 2022; it could be into 2023.
That's right. Yes, and that coupled with the fact that you could have a new tail event. We hadn't been worried about recession so far, and then so maybe the tail event of inflation is over, but then you get into a new tail event of a recession. So it's by its very nature, tail events are something that is hard to predict, but kind of easy to identify after the fact.
Hindsight bias is one thing that humans are very good at, as opposed to machines. That's for sure. Okay, I want to also go back to that prior intraday momentum strategy you had outlined. I'm actually trying to do some analysis on this now. Jim Bianco put out this idea that seemingly with the advent of zero DTE, you tend to have more, what he's observing as more mean reversion intraday because of these options that are expiring intraday. I'm curious, and I'm trying to do some work on this myself, because I think it's just an interesting structural change if that's the case. Is there anything that would suggest that that's true on your end, that some of these phenomena that you've back tested maybe on a go-forward basis now have this added variable which just make it noisier?
Oh, that's a very interesting. It's the first time I really heard that the single-day option make the market more mean reverting. My understanding is that option expiration typically generate momentum towards the expiration time. There is such a thing as the pinning effect that is well studied in academic literature, namely that the underlying prices tend to be driven towards certain strike prices that are particularly have high open interest. So I would have expected the opposite, that the popularity of zero-day option has increased intraday trend, at least towards the close, than mean reversion. So I'm certainly open-minded. I'm looking forward to someone who explained to me why they think that it would be the opposite.
Yeah, I don't know. It's something I want to test out myself, because I think maybe you and I would probably agree based on the data, although maybe wrong. I'm very focused myself on path behavior, so you tend to have more autocorrelation in weekly timeframes, much more negative autocorrelation within the week, which is why there's the term turnaround Tuesday, right? So kind of the shorter your time frame, it seems like the more mean reversion is likely to occur, at least within a week.
Oh, that is possible. Yes, I was focused on the intraday trend mostly. Yeah,
right, and that's what I'm saying. Right, so that's what I'm saying. The question is, does that now does that new factor, and I just don't know the answer, but I just think it's a fascinating question because you end up finding often, unfortunately, on FinTwit, people losing their minds off of intraday movement based on some experience they have, but the experience they had may not be relevant because now you've got this other variable suddenly, which is kind of the tail wagging the dog when it comes to the underlying asset.
No, that tail has been wagging the dog for many years. That is for sure. Yes, a lot of the leverage, and whenever one has a lever vehicle, whether that is a lever ETF or a swap or options or even futures, these are all derivative instruments, but they do have an effect on the underlying. So yes, indeed, that anything that are levered will have effect on the underlying.
I wonder if you've done any studies that suggest that AI, machine learning would result in better consistency depending upon the asset class it's being focused on, right? So if you were to apply AI, machine learning to commodity prices as opposed to stock prices, as opposed to bonds, whatever it would be, any evidence that would suggest that it's more than just sort of the idea of the code trying to learn, but just the domain that it's focused on?
Well, that is, I would say, a virgin territory, really, because as I said earlier, the current state of the art of using machine learning to discover trading signal had not been particularly successful. And because the current machine learning was focused on looking for patterns in prices or returns.
And is that primarily in stocks or across multiple
Of course,
asset classes?
multiple asset class. I mean, you have
Okay.
machine learners in every asset class looking for from crypto to OTC instruments, right? But with the new generation of large language model, generative AI, it is possible that machine learning can be applied at a high level. That is to say, it can absorb the published knowledge of all traders. And you know how many traders have written books, right? I mean, you just go to any publisher, there's like hundreds of books written by traders. And if the large language model can absorb the collective wisdom of all that is written about trading in any market and come up with trading rules and be able to backtest it itself using historical data so that it almost approximate understanding the causation rather than association. Because so far, as I said, machine learning applied to asset, applied to trading is all about looking for association, about correlation, not about causality, because it understands causality. But with large language model, I'm very curious to know, because it's now operating at the human language level, not on the price or returns data level, whether it will have a potential of creating trading strategies at the level of human with the understanding of causation. And that is, I think, one of the biggest unknown, and that I think that's the biggest opportunity ahead of us. Now, I might say that if you want to try it today on ChatGPT, and I've tried, and I say, hey, construct a momentum trading strategy on E-mini, it will just regurgitate some bland cliche Wikipedia article, right? Nothing that you can use unless you are very specific. But that is but if you have been keeping up with the latest research on large language model, which I have tried to, even though I'm not an expert in that, you will find that the next generation that already under covers at OpenAI, namely GPT-4. The GPT-4 language model is a order of magnitude better than what you see in ChatGPT. And according to the Microsoft research, it has glimmers of artificial general intelligence. And I believe that it is possible, once the GPT-4 is out, that you can ask it to construct a trading strategy that would impress a human trader. Let's wait for a few months, and we will have a new world ahead of us.
Another question from the audience. Big fan of Dr. Chan's books. Can you talk about how retail quant traders can leverage transformative AI to create more effective trading strategies while being limited by data access and computational resources compared to institutional players?
Well, one way that it can already do is to increase the productivity from ideation to implementation. So traditionally, the way to construct a trading strategy is you have an idea, you gather data, you write a backtest code and debug it for weeks, and then, okay, finally hit on a strategy that has high Sharpe ratio, find a programmer or you program yourself a live trading system and paper trade it for months. There's a lot of labor involved, mainly on programming, because to put from the moment that you generate an idea to the moment that it can actually do automated trading, that's a lot of programming involved. With generative AI, with our large language model, all that can be automated to a large extent. So you don't need to know a lot about programming, and you can simply instruct the generative AI program to write a program for you, a backtest program. Of course, you still have to buy the data. It doesn't, ChatGPT doesn't come with data. But if you can, get the program to run it through the data is a much more efficient process. And then you can say, well, I have this API that is specified by, let's say, Alpaca or Interactive Brokers or whatever brokerage you use. Create a live trading program based on this API and using this particular backtest logic. It will do so. I don't know how well. I haven't tried myself, but you can definitely try it and take a stab at it. And I think that increases the productivity of a retail trader tremendously. The only limitation still is, of course, you need to buy the data. But there's a lot of data vendor nowadays that competing for your budget. There's AlgoSeek, there is QuantGo, there is Data Bento. They are all trying to sell data, even high frequency data to you in a metered way. That means you don't have to pay for a large amount of data. You just need to pay what you need. And so I think data is also getting cheaper. Computational power is getting cheaper. And the labor involved in programming is going to zero because of generative AI. So I think that you are actually the retail trader in other words, the playing field is getting level at this point.
Does the fact that AI keeps on getting more and more pushed into our lives, do you think any of that really is going to ultimately matter for true longer term investors? I mean, obviously all this applies to more active tactical trading where there's a degree of turnover, but is there any application to real, almost like Warren Buffett type of investors where there's not going to be that much need to change your portfolio?
Well, yes. I mean, I think that ChatGPT already able to write a analyst report very intelligently, so they can study the financial statements and write a report. And I think it's no stretch of imagination to think that it can now be trained to read news on your behalf. So it can read whatever news that is relevant to a particular company and then correlate with the past returns when similar news occur as to what the likely reaction of the market would be. Right. So I think that, I've spoken to some institutional AI researchers, and that's where they're focusing on, because the ChatGPT, still the main power is its ability to understand natural language. And it's better than any existing system, whether you are Thomson Reuters or some other traditional sort of financial tax data sentiment provider. So ChatGPT can essentially be used as a converter from raw text to sentiment or even to a trading strategy. And from that point of view, it is certainly beneficial for long-term investing, because if you can read all the news about a company, can read all the financial reports about a company, you can read all the speeches, the conference calls by the executives, press releases, surely that is beneficial to a longer term strategy, a value driven strategy.
Yeah, no, that's a fair point. Although I would say it's probably not hard to beat financial reports written by human beings to begin with. Any other kind of final thoughts here for the audience as we wrap up? Again, everybody here, please make sure you follow Ernest Chan. But some people hearing all this might say that, well, the only way they're going to understand AI is if they're a coder or if they're a mathematician or know some of these statistical techniques. It sounds to me like you don't believe that that's necessarily the key. What would be sort of a necessary skill set you think people will need to have to just even be able to think about implementing AI aside from just going to Chat GPT? There's got to be sort of a mindset, I would imagine, in terms of how to think about proper implementation and limitations?
Well, I would say that the importance of programming skill is greatly diminished in recent months. I used to be a top-notch programmer, and I'm glad that I've not become a top-notch programmer for some years now because I don't need to be after the advent of this kind of generative AI technology. So I think as a trader, now you have to go at the higher and higher level, namely understanding causation. The programming is no longer necessary. You just need to focus on the higher concepts of the financial market. Form creative ideas. That's something that the current generation of chatbots cannot do yet, but maybe will soon, but not yet. So right now, we should focus on the higher level concepts rather than the nitty-gritty details, because those work, the chatbot can handle it already.
I think that's a good place to wrap this Twitter space up. Special thanks to everybody joining here, and thank you, Ernest. Really, for me, really interesting to hear your thoughts on this. It's fascinating.
Thank you for inviting me. Great to be here.
Thank you, everybody. Cheers.